Hi, my name's Ethan Ewing. I'm the president of Bills.com, and today I wanted to talk about when is the right time to refinance. A lot of people think about refinancing, but you got to understand when it's the right time. There are three reasons that people refinance. First one is to lower your monthly payment and oftentimes your interest rate. The second one is to reduce the term of your loan so you can pay your loan off quicker. And then the third one is to take cash out for home improvements, for a vacation, for education, or to consolidate some debt. Okay, there's some other reasons as well. Those are the three big ones. First one, reduce your monthly payment. You've got to look at what the current market is. What is the interest rate you can get? Okay, and in order to do that, there's a lot of places you can go online. You can come to Bills.com. You can get quotes from multiple lenders there. See what the market will give you. Okay, we have some other videos as well on shopping for a mortgage. Check those out first. Understand what the market rate will give you. Next, compare that against what your current rate is and look at the payments. The big difference here is what's your existing payment versus your new payment, and look at what that difference is. If it's $150 a month that you can save, that's a lot of money. That's $1,500, $1,800, I'm doing the math wrong, $1,800 a year that you can save. That might be worth it to you. So you have to make that decision. Is it worth going through the refinance process to save that much annually? Okay? Next one, pay off your loan more quickly. Really big one here. I consider this a luxury item. If you're in a position where you can afford higher payments and you want to get rid of your mortgage debt more quickly, then look at a 15-year loan. 15-year loans generally run at lower interest rates than 30-year loans. Your payments are going to be higher, and you're going to pay them off much more quickly and ultimately save more interest in the long run. You're going to be happy. Now, keep in mind, if you go from a 30 to a 15, there's no turning back unless, of course, you refinance, so you're obligated to make those higher payments. The other alternative to that is take your 30-year mortgage, calculate payments on a 15-year amortization. There's a great calculator on Bills.com to do that. Calculate that payment on a 15-year amortization and start making those payments to your lender. Make sure on your statements and on your checks to make a note to the lender that, hey, I'm making this additional principal payment. By law, they have to do that, but it's always good to remind them. Okay? The third reason to get a mortgage, get some cash out. And people ultimately will probably do that for home improvements, for education, sometimes to take a vacation, or to consolidate credit card debt. We've seen that a lot. Certainly over the last 5 or 6 years, that's been a big one. Now, some things to consider. This is a little bit of a slippery slope here. You have to be careful. If you're going to get cash out for a home improvement, that's a pretty good idea, because there you're putting money back into an asset you have. Hopefully you're increasing the value of your house. It's a pretty good move. If you're getting cash out to pay off some credit card debt, you have to be a little careful there, because basically you're taking some short-term debt and converting it into a long-term debt, which is your mortgage. So try to be a little careful there. The better thing to do probably is think about how you can reduce that credit card balance by stopping spending so much on the credit card, or by making more aggressive payments towards that credit card balance. And then, of course, there are other things like vacation and some other things that generally people want to take cash out for. So hopefully that helped, and we'll see you next time.